Welcome to the deep dive.
Great to be here.
So today we're not just, reading tax laws, we're going to follow the money.
Literally.
We've got our hands on a complete, detailed blueprint of a high-income Canadian tax calculation. We're using the official CRA line numbers as our map.
Right.
And our mission, really, is to take you on this journey from the moment income is earned through all the reductions and finally to the tax that's actually owed. We want to unlock how net income is truly defined.
And that structure is it's everything because the government doesn't treat every dollar you earn the same way.
Right. So for you, the listener, we need to clarify those three critical definitions: total income, net income, and taxable income. And more importantly, we're zeroing in on what we call the levers for planning. Levers for planning. I like that.
Yeah. If you can understand where a deduction reduces your base income versus where a credit just reduces the tax,
Yeah.
you suddenly gain this huge strategic control.
So to make this real, we're tracking a simulated taxpayer, and this person is intentionally complex.
Very complex.
Think high income, British Columbia resident, over 65, married to a spouse with no income of their own.
And that's not all.
No, they have a ton of claims. We're talking disability, caregiver expenses, massive medical bills, big charitable donations.
And standard pension contributions.
Yes.
So because this profile touches almost every major form, it gives us the perfect roadmap.
The complexity is the point.
Exactly. We're just following the CRA's mandatory calculation flow, step by step. Okay, let's start at the very beginning. Section 1, capturing the gross defining total income. This is the government casting the widest possible net, right? The absolute widest. Every dollar has to be aggregated. So for our high-earning resident, the anchor is employment income, line 10100.
And that starts us off at what?
A hefty $200,000.
Okay. And that's just the starting point.
Just the first layer.
Yeah.
The CRA then pulls in income from all these other diverse sources. So we have to add in commissions. That's line 1120 plus government benefits that are, and this is key, absolutely taxable.
So things like old age security.
Old age security, or OAS, on line 1100. And Canada Pension Plan benefits, CPP, on line 1100.
Yeah.
All of those income streams get reported right away.
And what about investment income? This is where a lot of people get tripped up.
It is. It's not just interest from a savings account. For instance, if our taxpayer sold a stock for a big profit, they only include the taxable portion of that capital gain.
Which is 50% of the profit.
50%, right. That goes on line 12700. So once you add up the employment income, the pensions, the investment income, all of it, you hit the first critical checkpoint.
Line 15,000, total income.
Exactly. For our high-income BC resident, that figure is $223,000.
Wow.
And that's the government's official starting point. No relief has been applied yet.
Okay, 223,000, that is a massive starting point. So now we move into section 2, where we pull that first strategic lever you mentioned.
The power of deductions.
Right. These are the dollars that directly reduce the amount of income the government can even tax. So what are the most effective deductions for this person?
This is where serious tax planning begins. I mean, they offer relief at the taxpayer's highest marginal rate, which is huge.
Okay.
In our case, this person used two major retirement savings deductions. They made an RRSP deduction, that's on line 2700, though it was only $500 used here.
So not a huge amount.
No, but what is significant are their registered pension plan or RPP contributions.
For listeners who might not be familiar, what's the difference between an RRSP and an RPP?
So an RPP is a pension plan that's typically set up by an employer. The contributions are usually taken right off your paycheck, they're mandatory, and they're deductible.
And how much did our taxpayer claim for that?
$5,000 for RPP contributions. This is key because it's a non-discretionary deduction. It immediately lowers their taxable base by $5,000.
So even smaller things like union dues on line 1200, they also chip away at that gross number.
Precisely. Every little bit helps. So when you tally up all the deductible amounts, the RPP, the small RSP, the union dues, things like childcare expenses, the total effect here is $14,500 in total deductions.
And that brings us to the second, and you could argue this is the most important checkpoint on the entire return.
Absolutely. This is line 23600, net income before adjustments. Okay.
We take that $223,000 total income, we subtract the $14,500 in deductions, and that leaves us with $208,500. And that right there is your official net income.
And most people just fly right past this number, don't
You
we?
do, but it is so critical because it dictates future benefits.
Okay, give us a concrete example. What government benefits hinge entirely on that line 23,600 figure?
Well, the biggest one for a high earner like this is the old age security, the OAS clawback.
The clawback, right.
If your net income on line 23,600 goes above a certain threshold for 2025, it's estimated around $82,000, the government starts taking back 15 cents of every OAS dollar you received.
And our taxpayers' net income is way over that. Way over. It's over $208,000, which means their entire OAS benefit is getting clawed back. So that $14,500 deduction, it wasn't just about saving tax this year. It was about trying, even if unsuccessfully here, to lower that clawback exposure.
So deductions don't just reduce the tax you owe now, they determine your eligibility for other programs later. That's a huge insight.
It is.
So that $208,500 is the final taxable income, line 26,000. That's the number the tax rates get applied to.
That's the base. And now we brace ourselves for Section 3.
Hitting the progressive tax wall.
Exactly.
This is where the rubber meets the road. We calculate the tax using progressive brackets first before any credits are even considered.
Right. And with an income of $208,500, our taxpayer is definitely hitting the highest federal tiers.
And that progressive structure means every dollar is taxed according to its bracket.
Right. You start at the lowest federal rate, 14.5%, but once this person crosses about $170,000, they're suddenly in the 29% federal bracket.
And it goes even higher.
Oh, yeah. Because their income is above the next threshold, about $246,000 using 2025 estimates. The very last slice of their income gets taxed at the absolute top federal rate of 33%.
That marginal rate, Payne. The idea that the last dollar you earn is being cut by a third or even more when you add provincial tax, that has to change how you think about earning.
It really does. When you add up all the federal rates, the federal tax before credits, it lands at about $59,500.
Wow. And that's just federal.
That's just federal. We still have to stack the provincial layer on top.
And we're in BC for this example.
Right. So our BC resident has a provincial tax structure that starts low at 5.06%, but it climbs fast. DC's top rate is 20.5%.
So you combine the federal 33% and the BC 20.5.
And the overall marginal rate on the very top dollar of their income is over 53%.
More than half of that last dollar just gone. Ouch.
Yep. So the calculated BC tax before credits comes out to around $30,300.
So we're looking at a combined initial bill of nearly $90,000.
That's right, before we get to any relief.
Okay, before we do that, we have to talk about payroll contributions, CPP and EI.
A vital distinction to make. We estimate that for a high earner, the mandatory contributions for CPP and EI top out at about $5,000 for 2025.
And the key thing here is that they're capped.
They're capped. This is critical. Unlike the bracket tax, which just scales endlessly with income, these payroll contributions stop once you hit the maximum pensionable earnings limit.
So it's a fixed, predictable cost, not a scaling tax.
Exactly. The bracket tax is the beast that keeps growing. Payroll is a known quantity. Understood. Okay, let's finally move to Section 4. The Strategic Relief Non-Refundable Credits. This is where we get to apply that final lever to chip away at that $90,000 tax bill.
Yeah.
And this is the moment to really internalize the core planning difference. Let me try an analogy.
Okay.
Think of your income as a tall glass of water. A deduction, like that $14,500 we talked about, is like taking a scoop of water out of the top of the glass. It reduces how much you have to drink.
It makes sense. Less water.
A credit, on the other hand, is just a discount coupon you apply after you've already calculated the price of drinking the whole glass.
So deductions are generally better for a high earner because they're reducing income that's being taxed at that painful 53% rate.
Precisely. Whereas credits operate differently. All federal non-refundable credits are calculated at the lowest tax rate.
The 15% multiplier.
It's a 15% multiplier. So if you have a credit amount of $10,000, you save $1,500 in tax. And for a complex taxpayer, their life situation generates huge credit amounts.
Starting with the basic one everyone gets.
The basic personal amount. That alone nets a federal tax saving of roughly $2,419.
And because their spouse had no income, they get another massive credit.
Exactly. The spousal amount credit provides another $2,028 in federal savings.
Okay.
Then you factor in their age. They're over 65, so they get the age amount. That's about $320 in savings. And because of their health, they claim the disability amount.
Another $1,350 saved.
And the caregiver amount, another $1,125. These credits, they're based on personal circumstances, but they stack up incredibly fast. Even the medical expenses contributed $300 in federal tax reduction here. But let's talk about one of the most proactive planning tools people have, charitable donations.
Yes.
Our taxpayer donated a substantial $6,000. How does that tiered system specifically reward a high earner like this?
It's highly strategic. So for anyone, the first $200 of donations is credited at the lowest federal and provincial tax rates.
Okay.
But, and this is critical, every dollar you donate after that first $200 is credited at the highest available tax rate, both federally and provincially.
So for our high-income BC resident, instead of getting a 15% discount on that remaining $5,800, they get a much higher blended rate.
Yes. They're essentially trading their donation dollars for tax relief at a much higher value. It makes the act of donating more cost-effective for them than for a lower-income person.
So what's the combined savings just from that $6,000 donation? Just from the donation alone, it's approximately $2,600. It significantly reduces their final tax bill.
So when we sum up all of these non-refundable credits, the basic personal, spousal, age, disability, caregiver, and that really potent donation credit, what's the total tax reduction?
It's huge, to approximately $13,600 combined federal and provincial.
Wow.
So if we subtract those federal credits, about $10,200 from the initial $59,500 tax bill, the net federal tax comes down to $49,300.
And on the provincial side?
We subtract the provincial credits, about $3,400 from the $30,300 bill. The net BC tax is now $26,900. Okay, that brings us to Section 5, the final tally. We've gone full circle. We started with $223,000 in gross income. Now we figure out what actually lands in the bank account. Let's just quickly recap the journey to get here.
Please. 1. Gross income, line $15,000, $223,000. 2. We subtracted the deductions, the income-based reducers of $14,500.
And that left our taxable income at $208,500.
Then came the painful subtractions, the cash that actually leaves the system. Net federal tax, $49,300. Net BC tax, $26,900. And the capped payroll contributions of $5,000. So after all of that, what's the ultimate takeaway figure? The final net income, line $50,000.
It's approximately $127,300. That is the number that dictates their lifestyle, their savings, and all their future planning.
So just over $127,000 is the final take-home on a gross income of $223,000. When you look at the total combined tax and deduction burden, that's about 43% of their taxable income.
It is.
Even with all the significant planning levers they pull, the RPP, the spousal claim, the donations, the system still demands a massive chunk of their earnings.
And this is exactly why understanding that net income figure is non-negotiable for real planning. That $127,300 is what the government uses to confirm eligibility for benefits, to calculate future clawbacks. It's the number you budget with. It's the number that government judges your entire financial standing by.
So we've successfully navigated the entire CRA calculation flow, from that initial aggregation of income through the heavy lift of deductions, the shock of the progressive brackets, and then the strategic relief from the credits.
We really saw the true value of that $14,500 in deductions.
Not just in lowering the tax, but in defining that critical net income checkpoint.
Right. And if we connect this to the bigger picture for you, the listener, knowing the mechanical difference between a deduction which strategically reduces your official net income on line 23,600 and affects your eligibility for things, and a credit which just reduces your taxes after the fact, that is the most powerful takeaway for planning your own financial future.
So which lever you prioritize depends entirely on your goal.
Exactly. Is your goal to reduce today's tax bill? Or is it to maximize your future benefits? They aren't always the same thing.
Which means that sometimes a deduction that saves you less money right now could be a far more valuable long-term tool than a high-value credit.
That's the strategic choice.
We encourage you to explore the concept of those critical checkpoints, specifically net income line 23,600 further in your own financial planning. Until the next deep dive, be well informed.